Well, hello and good evening, everybody. Thank you for joining us on this lovely Thursday evening. We really appreciate you all joining us and promptly as well, which is really, really good. For those of you who don't know me, my name is David Brewer. I am Director of FTA Finance. We specialise in arranging funding and finance for dental professionals, typically around practice purchase and also commercial lending. But tonight we're focusing on something very different, but equally, if not even more important, your personal residential mortgage position. For many dentists, being self-employed brings its own complexity when it comes to arranging mortgages. Income structures, dividends, retained profits, all of these can be interpreted very, very differently by lenders, which can make navigating the mortgage market a real challenge without the right guidance. And this is why I'm delighted to introduce you all to James and Michael from Coombes and Wright Mortgage Services. They're independent, whole of market residential mortgage advisors with many, many years of experience supporting self-employed clients, including dentists. And they understand exactly how to present you as a self-employed individual when they approach lenders, and most importantly, how to position your proposal, not just for today, but also in the future. Now, at the end of the presentation, which will probably last about 35-40 minutes, there'll be an opportunity for questions. On the screen, you've hopefully got a tab there where it says questions. So you can click that and type your question at any time during the presentation. And once the presentation is over, I will put those specific questions to James and Michael. And also just to remind you all again that this presentation is being recorded. So if you do miss any of it for whatever reason, there'll be an opportunity to go back and listen a little bit later as well. So without any further ado, I will hand over to James and Michael.
Thank you very much, David. Hi, everyone. Thank you for joining us this evening. I'm Michael, and this is James. And as David said, the presentation today, probably somewhere around 30 minutes, 40 minutes. I'm going to just quickly run through the agenda of what we'll be going through today. Really understanding mortgages for dentists and why they're so different. We're going to look at some affordability models and explain how different lenders differentiate and use different forms of income and give you some examples of them. We're going to look at loan to values and deposit sources. We're going to look at different mortgage schemes and how these differ and what's available in terms of mortgage schemes, repayment methods and the pros and cons of repayment methods. So there we're going to look at interest only and repayment mortgages, how mortgages can impact long-term financial positions, common mistakes that dentists and other people as well can make when applying for a mortgage. And we're going to explain our mortgage preparation checklist. And then, as David said, we're going to finish off with any questions and answers and share our contact details that you might have. So starting with us, really. So I'm Coombes and James is Wright, Coombes and James Wright. And we are from Coombes and Wright Mortgage Solutions. So Coombes and Wright Mortgage Solutions is our mortgage company. That we started in 2014, and it's made up of myself and James as advisors, as well as 5 other advisors and 4 administration staff that help with the paperwork and the compliance area of the business. So we started the company in 2014. We both used to work in corporate estate agency as mortgage advisors, and James was a manager of mortgage advisors. And really one day, about 12 years ago now, we decided that we could really do this on our own, and we wanted to sort of just do our own thing. So we started Coombes and Wright Mortgage Solutions, and over the years we've grown really. It's gone really fast, got to say, but we've grown as a company. And grown, I would say, in terms of the amount of mortgages we do. Probably myself and James doing 40 to 50 mortgages a month each at the moment, and the other guys somewhere between 10 and 20. So we do a lot of mortgages. We don't profess to know everything, but we do a lot of mortgages, and it's, to be honest, it's probably the only thing really ever done. In terms of the company, the head office is in Bookman's Park, so we're just around the corner from FTA. But we do have offices in St Albans, Chesham, Abbots Langley, London, Canterbury, and Dover. But really, I would say these days, although that's where the offices are located, we deal with people. Well, I deal with people up and down the country, as I'm sure the other guys do, because a lot of things can be done on telephone and on video calls and things. So, although they are our locations, it doesn't really restrict us in terms of where we can offer mortgage advice. We started working with the FTA probably, I think it's about 4 years ago now, but I could be corrected. And FTA, when they see an opportunity for someone that needs residential or buy-to-let mortgage advice and not business financing, then they sort of pass over any referrals to us, which are gratefully received. And that works really well. So hopefully today you'll really just get an understanding of what we do as mortgage advisors and hopefully where we can fit in and help you in terms of mortgage advice.
Hi everyone, I'm the other half of Coombes and Wright. Nice to meet you all, and thank you again for taking the time to dial in tonight. We appreciate it. It's your Thursday evening. Hopefully, if we can give you some insight into mortgages and a few snippets that you can take away, then obviously that's the idea. And as Mike said and David at the start, hopefully, if there are follow-up questions or in any way we can help you, we're more than happy to assist. Wherever possible. But what I was just going to kick things off with to start with is just understanding mortgages and why they might be different for dentists specifically. There is no mortgage that is designed for dentists. I think it's fair to say there's not a specific mortgage that is only available for dentists. I think about the only occupation where that is potentially available is actually for teachers. But in all fairness, even that option is pretty few and far between. But what I would say about a dentist is you're professional, and the fact that you come with the title of being professional, and rightly so with your relevant qualifications, that does come with a certain amount of lenience, I think it's fair to say, when it comes to a lender proposition and the way that they will view and assess your situation. Slightly more sympathetically than potentially people in other occupations. So that's the biggest string to your bow, if you like, in terms of us being able to look at things a bit more bespokely when you've got the occupation that you have. In terms of what does that actually mean, though, and what does that look like? It means that typically, if you've got someone, let's start with PAYE. So if you're PAYE within dentistry, what's fundamentally different there is that a lender might look at your employment history slightly more favourably. So rather than wanting to see a year's employment history in your occupation, they may well be prepared to look at less than that. Rather than looking at your current role being in position for at least 3 months, they might actually look at a new contract that's going to start in 3 months' time. So they might consider your income without you even starting a job just yet. So certainly going to be more favourable on the PAYE side. And then probably even more so when it comes to being self-employed. Traditionally, lenders are going to be looking for 2 years accounts. Whenever you talk to someone and you're self-employed, it's always a starting point in the conversation. It's fair to say that have you got 2 years worth of accounts? Well, if you're in the industry that you guys work in, then actually we could potentially work with 1 year's accounts rather than two. We could potentially work with retained profits. We're going to talk a little bit more about that as the presentation goes on, but talking about using retained profits rather than just the good old salary and dividends. Lots of advantages of working with retained profits, and arguably why shouldn't we? If your business has earned the money and they've retained the profit and you've not spent it yet, why should you be a disadvantage for that? So there are certainly lenders that will take a view on that. Talking about potentially being able to borrow more, maybe. In particular, people that might have come into the industry fairly recently qualified dentists, for example, the projection of their income is likely to be slightly more steep. So you might find that lenders are prepared to be a bit more generous in those situations. Looking at the deposits, potentially being prepared to consider a slightly lower deposit than maybe your more traditional applicant, 5% deposit, 10%, again, because of the stability of the occupation. Looking at specialist lenders that really do look at professional, I would say, rather than specific dentists, but again, more favourably. and also considering potentially future earnings, not just what's being earned right now, and looking at projections from an accountant, PAYE contracts that are potentially going to start in a few months time, and contractors as well. So lots of advantages. I think it's fair to say that can be considered away from and outside of the normal look of a mortgage. So that's some of the basics of what we're aiming for.
Okay, so affordability and how lenders assess applications. So prior to the call today, I just had a look at a different example of how lenders may assess income. So some lenders will look at salary and dividends. And most of them, I would say, will look at the last 2 years' salary and dividends. And they'll either average the last 2 years or take the most recent year if it's lower. But some lenders will, as James just mentioned, would look at retained profit. So what that's talking about is businesses that make a certain amount of money, but the director, for whatever reason, doesn't need the money, doesn't have the expenditure needs to want to take out the money and pay tax on it, doesn't need to take out the income, so therefore their salary and dividends might not be as high as the profit that the company is making. So a retained profit lender would be looking at profit after corporation tax plus salary. Okay, so, and those two numbers can be very different. So in the example I looked at earlier, I looked at a couple, 40-year-old, the wife isn't working and the other person is working, and they had a salary of 12,500, which is relatively normal. So most people, for tax purposes, keep salary low, and dividends of 50,000. So in total, I had a total income of £62,500 that they took out of the business. So you sort of high street lenders, people like Halifax, NatWest, Santander, what they're going to do is look at your salary and dividends and then give you a loan amount based on those, on the average of the last 2 years. And when I took in those figures for the two 40-year-olds with two children, they will be looking at lending something like 258,000. Okay, but having looked at the company accounts for this person, actually the net profit after corporation tax was 125,000, and they also paid themselves a salary of 12,500. So if I then sort of switched lender and didn't look at a lender that just does salary and dividends, but looked at someone more specialist, if you like, it was quite interesting that the maximum loan amount based on using the net profit plus salary was coming up to 687,500. So it's much bigger because they're willing to use the money that's retained within the business. And I think that's really important, because sometimes I see clients that have, they come to me and say, look, Mike, can you help me? I've been to see NatWest, I've been to see Halifax, and they're saying, I can only get 200 and something. Well, actually, if you look at the accounts and just go one step further, if there is retained profit, and there isn't always retained profit, but if there is, then that really is a good example that we can get more. Okay, and then the next subject is loan to value impact. So how the loan to value can impact how much you can borrow, and also deposit and sources of deposit. So starting with loan to values, lenders are very keen to see what the loan to value is. So by the loan to value, I mean the amount you're borrowing as a ratio of the value of the property. And lenders tend to look at sort of 5% deposit being the very minimum. Then they go 10%, then 15, 20. Some lenders do 30, and then 40% deposit. And as we move through those ratios, the interest rate becomes better, and also the requirements that lenders have become less. So as an example, if we're looking at a 95% mortgage, you can expect the lender will definitely want bank statements. They will want to go all through the accounts, and they'll want a lot more evidence than if someone has a 40% deposit. So I guess what we're saying there is the bigger the deposit, the better in terms of interest rate, but also in terms of the ease of getting the mortgage. And that moves on really to the deposit. So when we declare our deposit, and that could be 5% or it could be 40%, the lenders are very interested in the source of the deposit. So we need to be able to prove the deposit, and that's normally done by way of, say, 3 months bank statements confirming that you have the funds. But the question will also be asked, where did the funds come from? And there's lots of different places that a deposit could come from. It could come from general savings. It could come from gift from family, is quite a common one. It could come from the sale of a business or the sale of a property. But I think that the key thing is to get the ducks in a row and just ensure that we're able to prove where the deposits come from. Sometimes money comes from abroad, which is acceptable depending on the country it's from. But quite often there's more evidence needed when deposits come from abroad. And what I always say to my clients is it's best just to get as much information as we can as early as possible. Because our job, and it makes it easier for us and the clients, is to try and make sure the mortgage process is as painless as possible. And that's definitely aided by having all the evidence up front as early as possible.
Okay, so hopefully that was helpful so far. We're just going to move on to potential availability of different mortgage schemes. I feel that over the years that I've been doing mortgages, that actually this has become less complex rather than more, which is unusual, to be honest, because it feels like most things become harder work rather than easier. But generally speaking now, most products, whether we're talking residential or buy-to-let, typically you're looking to choose between a fixed interest rate or a variable tracker linked product. So typically they're the two. There are a few anomalies either side, but generally speaking, that's where most lenders, both high street and more bespoke, will target their product range. So a fixed interest rate, as the name suggests, is that it will fix that monthly repayment for you or enable you to be able to budget over a set period. Now, most lenders will target their best products typically at 2, 3, and 5 years. So you get the security over those set periods. But we are finding a bit more of an appetite for longer term fixed rates, 10 years. And there is new lenders coming to the market that are taking a more American approach, I would say, to mortgages. And they're actually offering fixed rates for as long as the full term of the loan, i.e. 25 or 30 years. So real long-term security, which for certain clients will certainly tick the box that they're looking for. Certainly if you took a longer-term fixed rate before the Liz Trust moment in recent years, you'd certainly be pleased with that decision now, dare I say it. But yeah, so fixed rates, that as the name suggests, just gives you that security. The big thing with fixed interest rates, brilliant if rates are going up, not so nice if rates are coming down, because you're not going to benefit from any rate reductions whilst you're in a fixed rate. So you really need to think about how long do you want to actually be tied into this mortgage for? And as much as at the start of the point of the transaction, if you like, that security is great. You're going to put issues further down the line, i.e. if you want to move home or pay the mortgage off early. Yeah. If you go down the route of a variable tracker product, that tends to be linked to the Bank of England base rate. So you still get your mortgage through the likes of Halifax, Santander, or whoever it may well be, but the actual product will be linked to the Bank of England base rate. So the Bank of England base rate is currently 3.75, and a lender may offer you, for example, 0.5% above the Bank of England base rate for the next 2 years, giving you an initial rate of 4.25. If the base rate moved to 4.25, you would be at 4.75, and so on. So you would move with that loading above the Bank of England base rate. Again, great if rates are coming down, fantastic, you're going to benefit from that. But the opposite applies here. If rates start going up, you're not going to have that security that a fixed rate would give you, and obviously your payments would fluctuate accordingly. I would say, as a very average rough guide at the moment, if you compared a 2-year fixed rate to a 2-year tracker, you're looking at a difference between 0.5% to 0.75% lower on the tracker. Now, there's two thoughts of travel here in terms of why that might be. Is it because the general thought out there is that the projection is for base rate to actually go up by 0.75%, or is it that they think that the base rate reductions that were expected pre what's going on in the Middle East at the moment aren't now likely to happen? But as I say, as a guide, if you compared them at the starting point right now, a tracker is probably around 0.5 to 0.75% lower than a fixed rate. So the argument is it worth that gamble or not, I suppose? So that's the typical products that you're looking at. There's some quirks within that as well. So a product that's not new, but I would say certainly one of the newer in terms of mortgage life, is what's known as joint borrower sole proprietor. That's definitely becoming more popular. So what this is where you have two applicants that go on the mortgage from the liability of the mortgage, but only one applicant actually goes on the deeds. Now, there can be varying reasons and requirements to have a situation like that, but the classic example would be potentially someone newly qualified in dentistry. They've just started out. They've got their first good role, PAYE. Their income projections are certainly an increasing one, but right now the affordability doesn't quite fit for them to be able to borrow at the level they need to for their first home. Mum or dad come along and they then want to support them in some way, and they potentially have the affordability to go alongside them on the mortgage. So both incomes are now on the mortgage. But the big quirk with joint borrower sole proprietor is that the parent doesn't go on the deeds. So the big advantage there is that you don't have the higher stamp duty because mum or dad aren't buying a second home because they're only going on the liability. They're not going effectively on the ownership. So a real quite a quirk and can save people considerable amount of money. You can also reverse that. So you might have a situation where actually parents are coming to the end of their career now, potentially about to retire or have retired, and now their income isn't quite enough to justify the mortgage that they still have at this stage in their life. So they might ask their child to actually, or their adult child, should I say, to now go on the mortgage to support them from an affordability point of view, but again, not to go on the deed. So that's known as joint borrower sole proprietor. Another option that you may or may not have heard of is an offset mortgage. Not probably quite as popular as what it's been in the past, but certainly out there, certainly a bit more bespoke, and not as many lenders offering them, but it equally does have a home for the right applicant. And this is where simply you have a savings account that sits alongside your mortgage. And whilst any monies are sitting in that savings account, you don't pay interest for the equivalent amount that's in the mortgage. So £200,000 mortgage, 100,000 is sitting on the savings account. You're only going to pay interest whilst that money's in that savings account on the remaining 100. So a significant amount of saving potentially could be made, because if you're saving an interest rate at 5% on the mortgage, but you'd only be getting 2% in your savings, you can see the potential advantages of that. Can be quite popular for those people that are self-employed, because if you're saving throughout the year for your tax bill, whether it be company tax bill or personal, you would always want to have instant access to that money. So you wouldn't want to lock it away in long-term bonds, but it's a way of getting potentially effectively a higher interest rate for that money whilst it's sitting in the offset account, but without risking the money, because you're not paying it off the mortgage. It's simply sitting in a savings account, so you have instant access with no criteria as such. And then just sort of moving over to buy-to-let and limited company versus personal. So buying of buy-to-lets has definitely become, a lot more thought, I think is fair to say, needs to go into a purchase of a buy-to-let now. I don't think we're going to get as many accidental landlords as what we've had in the past, and that's really all been driven by legislation, but probably the biggest thing being the rules around taxation. So the rules around taxation changed around 4 or 5 years ago, where fundamentally a buy-to-let that's in a person's personal name, you can't offset the mortgage interest as a commitment against the income that you're receiving. Bit more to it than just that. And as I say, I can't give tax advice. I'm not qualified to. But the first thing we would always be saying to our clients is you need to talk to an accountant before you go too far into a transaction on a buy-to-let. Should you be doing it in your personal name or a limited company? Because the advantage of a limited company is that you can offset the interest against the income. Now, if you're a higher rate taxpayer, that can be a significant tax saving. And if you're looking at this as a long-term project, long-term tax saving as well. So that's certainly something that existing buy-to-let landlords, new buy-to-lets new landlords coming to the market having to think about. And then I'm just going to quickly move on to repayment methods. And this applies whether you're looking at, again, a residential mortgage or buy-to-let. Not massive explanations needed here. This is really the fundamentals of what in the industry is known as your attitude to risk. So do you have a cautious attitude to risk? Do you want the guarantee that your mortgage is going to be paid off by the end of the term? Or actually, are you a bit more adventurous about how that mortgage might be paid off? Would you rather only be paying the interest on the mortgage because actually you feel that your money could be working harder for you in some sort of an investment or a project elsewhere, buying a dentist, for example, or whatever it might be? Could that money be doing more for you rather than actually being paid off the capital? And again, that's a very individual decision to be made, and potentially it depends on the project that you're doing. Again, whether it's residential or buy-to-let could fundamentally change. But repayment, you're paying capital and interest. You know the mortgage is being paid off. Interest only, you're only paying the interest, but that frees up some money for you to be able to use potentially to invest in a different way. So that's what you're looking at there.
Okay, so mortgage decisions and the impact they can have on long-term financial position. So I think there's probably really two key things that I wanted to go through here. The first one being the length of the term of the mortgage. So by length of the term of the mortgage, I'm not talking about maybe a fixed rate for 2 years or 5 years, but we're talking about the overall term of the mortgage. In the past, I think probably when I first started out, mortgages were typically 25 years, not necessarily any rhyme or reason for that, but often people would have a 25-year mortgage and over the 25 years that would be paid off. But what's changed since then, I guess, is that people are definitely working to an older age, so working longer. People are living longer, and property prices have drastically increased. So when I speak to clients, I always like to definitely talk in depth about the mortgage term. And often I see people that have just done something online or been to see their own bank and they come out with a 25-year mortgage quote. But really you need to look at that in detail, because if you do a mortgage over a longer term, and a lot of lenders these days will definitely lend to age 70, a lot will go to age 75, and some would even go to age 80. Now, of course, we need to work out how that's going to be financed. So are you really going to work to age 80? Probably not. But some people may definitely work to age 75. But it's important to note that if you did a mortgage over that term, it doesn't mean you're going to have a mortgage to 75, because over the term of the mortgage, you might sell and move, you might do an overpayment. Sometimes people may get inheritance or something and look to overpay that way. So I think it's really, really important to try and pin down the best mortgage term. And mortgage terms don't only go in 5 years. So you might have 25 years, you might have 30, you could have 31, 32. So it's important to just look at different mortgage terms and how they suit what you're looking to achieve. And the other thing's overpayment facilities. So these days, I would say most lenders, if not all, really, there probably are a few unusual lenders that don't allow it, but most lenders would let you overpay to the mortgage. And by overpaying to the mortgage, that could be on a monthly basis, or it could be on an ad hoc basis, or you might do it once per year. But most lenders would allow an overpayment of 10% of the outstanding mortgage balance per year. And some lenders, NatWest as an example, allow you to overpay 20% now. So that's double what everyone else does. And there are some products out there, fixed rates and trackers, where you can overpay unlimited amounts. So sometimes, we might look at a mortgage case and put the mortgage term over 20 years. Sorry, not 20 years, 40 years. So the monthly payment you have to make is the lowest it possibly can be. But then you could look to reduce that mortgage term by making overpayments, but you can fall back on the longer term if life dictates or if you want to. So I think that's an important thing to look at. So mortgage term and overpayments are important. Really, I guess the shorter the mortgage term, then you're paying less interest overall. So the shorter mortgage term you can do is better for you, because you're paying less interest, you're paying back the mortgage more quickly. If you do put the mortgage term over a longer period, then you're paying more interest and less capital off. So it's really important to try and tailor that to what we're looking to do.
So we're now sort of moving on to common mistakes dentists make when applying for a mortgage. That's a bit harsh, really, dare I say. It's not just dentists. I think it's fairer to say common mistakes that anyone might be able to make when they're looking to apply for a mortgage. And I suppose the key here, with like with a lot of things in life, it's all about preparation. Preparation really is key. Now, I know no one's got a crystal ball and they know exactly what's going on with their life in the next, sometimes they don't know what's happening in the next 5 minutes, let alone the next sort of 6 to 12 months. But I think if you can try and, as best as possible, predict when you think you're likely to want to purchase a property, whether that be a residential property or a buy-to-let, or to move home. If you can start and get the wheels in motion and start some conversations at least 6 months in advance, but ideally probably as far as a year in advance. I mean, I sit with some clients and they sort of say to me that they feel a little bit bad that they're sort of wasting my time because they might not buy for 6 months, they might not buy for a year. And I genuinely say to them, I am much happier chatting with you now, getting our ducks in a row, so that when you do, more seriously want to start viewing and really get the ball moving, that firstly we know each other, we know how we work, but also we're prepped up and ready, and that we've got our numbers right in terms of what we're going to need to actually get the mortgage at the time that you're ready to move. So don't ever hesitate to start those conversations early. Certainly if you wanted to chat with us, you could, but whoever you may well want to use in the future. I think specifically a bit more to dentists, though, it's making sure that you're not just assuming that all lenders are going to look at your situation favourably just because you are a professional. Certainly, the majority will, but I think it depends where exactly you are in your cycle of career at the point that you're making those inquiries. Just walking down the high street might be a bit disappointing, depending on that cycle and where you are within it, because there are very bespoke lenders, as we've touched on throughout this presentation, that are going to look at things more favourably than others. Thinking about the way that your income is actually set up, and again, we've already talked about this, but are you PAYE? How long have you been PAYE for? Is it a permanent contract? Are you contracting? Are you on a day rate contract for some reason? Or is it more freelance? Is it whatever that scenario is? It's just sort of thinking about how's that going to fit the puzzle of that lender's criteria. I always say to clients, mortgages are not rocket science. They really aren't rocket science, but what they are is quirky. It takes just one bit of criteria to go from a yes to a no, and unfortunately the whole application falls. So I know that for Mike and I, it's about finding those little crinkles that we need to iron out before we start. And the earlier on we know about it, the easier it is to iron through the problem. So just thinking about that early on. And then if you're self-employed, what's the situation with your self-employment? Are you a sole trader? Are you a partnership? Are you a limited company? We see a lot of clients that understandably, as they go through their career, a big one is going from a sole trader to a limited company. Now, although when we're chatting with the clients, it's quite clear nothing has really fundamentally changed with their employment or their company. It's just from a tax advantage point of view normally as to why they've made that move. But if you make that move at a critical time in the mortgage journey, that is going to be a big reason that potentially an application will go from a yes to a no with certain lenders. A lot of lenders will understand that situation, but a lot of lenders will turn around, well, if you only set the limited company up 6 months ago, you've got no accounts for it, we can't lend to you, because as far as we're concerned, there isn't really a business that we can judge you on at this stage. So again, if you'd had the conversation early on with someone like ourselves, it might be that we say, well, look, if you can, park moving across from sole trader to limited until your next set of accounts, for example. Right now, Mike and I have been having lots of conversations, bearing in mind the tax year has just ended. From January, February, we set up a lot of meetings with people so that before they go and see their accountants to finalise their year-end accounts, they go armed with lots of information around what the impact will be on their mortgage, depending on how those accounts are finalised. So again, it's just sort of thinking about that. Applying too soon, that sort of falls into the same thing. So applying too soon in the process of being self-employed, as I say, if you want to have the best options in front of you, I think it's fair to say having 2 years finalised accounts, 2 years tax calculations definitely will tick most of those boxes. But that's not to say that 1 year isn't potentially an option. Looking at your credit reports and your credit files, we're strong advocates of check my file or call credit. So various lenders will use different credit reference agencies. You might have heard of Equifax, you might have heard of Experian. Some lenders will use Equifax, some will use Experian, some will use both, some will use TransUnion. So it's amazing how we might go to one lender and get potentially an accept. You go to another and your scorecard might not look as favourable. We sit down with clients and we do what's known as an agreement in principle, which is like an initial check early on in the process, and it might decline. And the client's got no idea because they've been checking their credit report on Experian, but they didn't realise something had been flagged up with Equifax. So if you get check my file, the benefit of that, it shows all three of the main providers in one report. So that's something to definitely be keeping an eye on, because that will tell you quite a lot about how the lender's going to view you when you get to the point of starting the process. Talking about affordability and how that's going to be assessed, just making sure that you're being realistic around how much you might be able to borrow, the impact of the deposit, as Mike talked about earlier, how that's going to be looked at. But also, it's all well and good getting the mortgage, but it's making sure quite genuinely that it is affordable for you. I know that Mike and I spend a lot of time with clients talking through budgets and budget planners and stuff like that. And they really are important. I genuinely say to clients, get a few blank versions of the budget planner and work out a few scenarios. If you buy at this level, meaning this sort of mortgage, what are the outgoings of that property likely to look like? And is it going to be affordable if we manage to achieve this size mortgage or aim for? And the longevity of it, is it really going to be affordable? Because I know that, compliantly, Mike and I will always get it right, but I would argue even more importantly, ethically, we want to get it right. I would feel terrible to have a phone call from a client that's struggling to maintain the mortgage because actually they overstretch themselves by too much because they focus too much on borrowing rather than the affordability side of it. And also thinking about the structure of the loan. Should you be picking a 5-year fixed rate right now, when potentially interest rates might come back down a little bit, or you're actually thinking of moving home? Do you really want to be getting locked into a long-term contract effectively when that might not be quite the right move? And a lot of the time that's rushing into the decision. You don't want to be rushing into the decision. So I suppose the bottom line with that really is, if possible, preparation is the key, I would suggest.
Okay, so the final part of our presentation is really the practical mortgage checklist, and we will be able to produce these for distribution for you later. But I think there's really 9 main points or 9 key points that are good to be prepared prior to getting a mortgage. So I'm just going to go through each of those in turn. So the first one would be to ensure that finances are in shape. So as James mentioned there, Check My File is an amazing report. The best one by far, I'd say, because it produces the 3 main credit reference agencies. So get your credit Check My File report. Have a look at it and see if there are any issues on there. If there are issues on there, then we just need to know as soon as possible. And we need to know what the issues are, how big they may be, and then we can find a lender that can deal with it. And it's far, far better to have that as early in the process as possible, rather than coming in late and finding out there's a problem and then trying to deal with it. If we know what the problem is, then we can find our way around it. Proof of income. So proof of income's the second one on the list. Proof of income. Best thing to prepare: last 2 years accounts, last 2 years tax calculation, and last 2 years tax year overview. So a tax year overview goes alongside a tax calculation to confirm self-employed income. Proof of deposit. So I spoke about deposit earlier, but build and evidence proof of deposit and also source of deposit. So proof of deposit will be 3 months PDF bank statements, not just a screenshot, but a proper PDF bank statement with names on. And then we also need to be able to explain and evidence where necessary where the funds have come from, so the source of funds. Understanding affordability. So as we mentioned, we always go through budget planners to ensure that the mortgage is affordable, not only now, but if interest rates were to change, so we can look at stress testing to make sure that things are affordable no matter what happens. The mortgage strategy, so by that we're talking about fixed rate or variable rate. Do we want to fix? If we do want to fix, for how long? Mortgage term, how long do we want to pay the mortgage over? Do we want interest only? Do we want repayment? So that sort of thing. Speak to a broker, so ideally speak to us, and we can talk about all these different things and ensure that you're prepared as possible. Prepare key documents. So that's number 7. Prepare the key documents. Key documents for identification would be proof of ID. So that could be passport and or driving license. Proof of address. So lenders like utility bills, bank statements, credit card statements. Proof of deposit, as I mentioned, and the proof of income, ensuring that's ready. Avoid red flags, number 8. So ensure that no mortgage payments or any payments on any credit facilities are missed in the months coming up to the mortgage. So lenders do tend to look back over the last 6 years, but the closer to the time of it happening and applying for a mortgage, it's more and more of a problem. So it's important not to miss anything. Lenders often like to look at bank statements, so it's important to look at the bank statements, just make sure that we don't think there's anything on there that a lender might not necessarily like, or we need to ensure that we've declared anything, any commitments, any childcare costs sometimes that are on the bank statement. So it's always good to try and review them before sending them to a lender so we know what we're doing. And I think the final thing, so number 9 on our list for our checklist, is to gain an agreement in principle. So what an agreement in principle is putting forward a client's details. So by details, I'm talking about income, residential history, names, address, dates of birth, putting it forward to a lender and say, can you credit check me, and am I suitable for a mortgage? At the stage of an agreement in principle, you don't need to prove everything, but we need to know that we can prove it to be able to get the mortgage. And that's a key point really on the mortgage journey. And also when looking at properties, you'll find that often estate agents will be keen to know if you're agreed in principle. One reason is they want to sell you a mortgage, but also they want to know that they call it proceedable. So you're ready to go. And when you do find a house, you can move quickly. So that's really the 9 key points on our mortgage checklist.
I hope that's been helpful. Again, we really appreciate your time, obviously listening in, dialing in tonight. We're now obviously back over to David and open to any questions that you might have got, and we'll do our best to answer them for you.
Yeah, let's say the questions are already coming in thick and fast, I'll be pleased to say. For those of you who are on here, if you've got any further questions, please type them in now. James Michael, very insightful, a very good presentation. I knew it would be, so thank you ever so for this. For me, it shows the importance of working with specialists. That live example that you gave, where one bank dealing with a self-employed individual, the maximum you can borrow is potentially 250,000, compared to another lender with the same set of accounts, potentially 680,000. So it's a staggering difference as well.
Yeah.
Another take home I took as well, very quickly, the credit file, the check my file. I didn't realise there would be so much difference between the credit reference agencies. So if there is this one oversight, the check my file, that can look at them all, then absolutely brilliant. And also, obviously, the difference between being a limited company and a sole trader as well. And I guess the importance of speaking with an independent advisor, such as you guys, first, before you make any drastic changes to your structure, before you're going to be taking out a mortgage. So they're the few points that I took away. I'm going to go on to the questions now. So I've got them here. So, right, these are in no particular order, but the first one, very topical one. How has the recent conflict in the Middle East impacted mortgages and interest rates?
Okay, so drastically, I would say, to a certain extent. So Well, it seems to have eased off a bit at the moment, but sort of pretty soon after the war started, we were seeing lenders pull rates with pretty much no notice. Um, and when I say pull rates, well, I think clients sometimes, if a lender's offered a mortgage offer, they don't suddenly pull that mortgage offer away from people. When they talk about pulling interest rates, the rates on offer are no longer on offer, and they take them away, and then the next day they come in with a higher rate. Um, and it took us back to the Liz Truss problems, or after the Liz Truss problems, in terms of interest rates being pulled pretty much every day with very short notice, and going up the following day. And then what would happen next is simply whoever was at the top of the list would then think, hang on a minute, our rates are too low, we're going to put them up, and then they do the same, and it's a bit of a race to the top. So it was lots and lots of late nights, because I could be sitting at my desk at 4 o'clock and get an email through saying we're changing our rates at 10:30 tonight, and these are the new rates, and they're going to be 0.5% more. Now, if I've spoken to a client that day, or I know there's something that needs to be done, we will do that, And although it was hard work, I enjoy it, and I want to get the best that I can. So that definitely has played a part recently. So it's made everything much more urgent. I think an important thing to note, though, is that interest rates do go down during the time that these people are purchasing the property. I can change the interest rate. So before it started, I can amend it and change it. And also, I've been locking in mortgages as early as possible. So some lenders, we can secure a mortgage now that actually doesn't need to start until early next year. So that was particularly important when the rates kept going up. And I knew, for example, I had a client that was finishing at the end of November or the end of December. I was on the phone saying to them, look, we can secure a rate now. This is a good thing to do because every day they're going up, but actually you're not committed to it. So don't worry, if interest rates go down between now and the end of the year, we are going to change it. We're not just going to sit on it. But the point is, if they go up, you're going to be pleased you've done it. And that's a really, really, really big part of my job.
Well, the only probably thing I would just add is, hopefully add on a little bit of a high, is that we have seen in the last sort of 24, 48 hours rates starting to come off a little bit. The big Santander, Halifax and HSBC have all announced rate reductions in the last 48 hours. So hopefully that means that the market's starting to settle a little bit. I don't think we're out of the woods, as they say, but it is certainly looking a bit more positive. I think pre the war, there was very much an expectation that the base rate, as I said earlier, is at 3.75. The expectation was that by the end of 2026, it would get to between 3 and 3.25. And a lot of that was priced into the market. And so I think that it's a bit of a double whammy what we're seeing, in as much as that pricing is being pulled back out of the market and then a margin put on top, if that makes sense, because of the element of risk of what's happened out there, and the big one being inflation. Inflation was the driver of rates before, and that really seems to be the driver again, with obviously the issues around energy. But whether it being too optimistic or not, I don't know. But my hope is that, although I do appreciate, I think it will take a while to unwind, I actually do feel that hopefully once things do settle out in Iran, that has been the driver for rates to go up. So if that does correct itself, you would hope that actually we should see them start to come back off again. But that's an opinion.
Super. We'll keep that positive vibe. Now, I've got quite a long question here now. You have, to a degree, Michael, actually answered some of it already. The question is, I took out a 5-year fixed rate 4.5 years ago. At a very low rate of interest, I think about 1.7%. I know it's gone up. It's due to, I think it's December that it's due for review. How early should I be speaking with you about this?
Now. Yeah, so I'd say the answer to that is now, for the reasons that I mentioned. Some of the ones, interestingly, some of the ones I did the other day, probably the lowest I've ever seen. I think they were on a it was either 0.98 or 0.88 fixed rate that they did 5 years ago. So it's a common thing at the moment that people are coming off low rates and going on to higher rates. But the sooner we talk and the sooner we secure something, the better, I would say, remembering that you're not committed to it. You're securing that rate. So if you did think rates are going to come down, that's not a reason not to do it, because no one knows whether they're going to go down or go up. Book the rate, hope it gets better is the best course of action.
Super.
Fundamentally, there's no downside to securing it early. And just be really clear on that. There are lenders that will allow us to secure a rate potentially up to a year in advance.
Yeah.
So speak to you guys early is the key.
Yeah.
The key there.
Yeah.
I'm gonna, let's say, quite a few more questions to go through here. Is it easy to borrow money to renovate a property that you've already purchased without a mortgage?
Yes, potentially it is. Some lenders can be a bit restrictive in the first 6 months of the purchase. So if you've bought and you're trying to, so if you've bought for cash in and you're trying to refinance within 6 months, some lenders can be a bit funny if it's within that time scale. If it's outside of the 6 months, then no, I don't see why you should have too much of an issue with being able to raise for home improvements. It sometimes depends on the extreme of the home improvements. Are you moving out? Are we talking about, going as far as knocking a building down or whatever? But general home improvements, no, I don't see that being a problem. And even if it was within the 6 months, there are a lot of lenders that would allow you to do it. The only thing you need to be a little bit careful of sometimes there is if you're trying to, for some reason, say that it's worth a lot more now than what you paid for it originally, because they'll tend to go by the original purchase price.
Unless we can evidence works that have been done. So I suppose sometimes that happens if people buy a property at an auction for cash. Maybe it's got a low lease, maybe it needs complete renovation and maybe an extension as well. And often that takes longer than 6 months to do that stuff anyway. Then we can do it. So it's easy to do. Easy.
Super. So would that apply the same on a buy-to-let as main residence?
Yeah.
Okay. Good. A very pertinent question here. What fees do you charge for arranging a mortgage?
So the first thing is we offer a free, no obligation consultation. We don't expect clients to commit to us before we've had a really thorough and good chat with them. But in a nutshell, our standard residential fee is $399, and our standard buy-to-let fee is $499. And that's from initial free consultation all the way through to the end on completion. And also, I think Mike touched on it in particular. On all transactions, but even purchase transactions, we spend a lot of time rebroking for clients. Okay, so if a client starts the purchase journey, we all know it takes roughly 3 to 4 months for a purchase to go through. Well, rates could change either way over that period. If they go in your favour, what you don't want to do is just leave the rate that you got at the start. So we're more than happy to rebroker it, and you wouldn't pay us another penny.
Perfect. Thank you for clarifying that. Next one, it's about insurances and protection. Is there any particular type of cover that you would recommend, even though the lender doesn't, on a mortgage?
So the only insurance that you compliantly or you have to by law have from a lender's perspective is buildings insurance. That's the only insurance that you have to have. Now, again, compliantly, we will always go through, ethically, if we're setting a mortgage up for someone, it's only right that we talk about how they can protect it. What decision a client makes is totally their decision. As long as it's an informed one, then we've done our job properly. Of course, going into that sort of financial debt without protecting yourself sensibly, do you need every insurance going? No, I don't believe that. But should you be thinking about at least the bare minimums and something maybe a little bit more? Yes, but it is quite an individual thing. But the only one you have to have is buildings insurance. But certainly part of our service would be covering off all of the other options that are available and, where possible, making it affordable and within a budget that you can be protected to a certain degree.
Yeah, as part of our regulations, we have to talk to you about mortgage protection and explain the pros and cons of everything. But it's important to stress there is no obligation. We just have to ensure that we've explained it all properly to people and really see what their thoughts are.
Perfect. I'm conscious of the time. I've got one question for you, one final question, and it's a cracker as well. What are your views on a dentist who may be undergoing GDC investigation which may or may not have implications on future earnings?
That's a good one. Forgive me, but obviously the specifics of that investigation, I'm obviously not totally clear on. I suppose, I mean, fundamentally, I don't know that question would get asked in a mortgage application, if I'm being really, really honest. I don't. I think the bigger thing here is if they've got concerns about their income changing in the future, well, that comes back to affordability. And I would be more concerned about, well, I might be able to get the mortgage through for you, but are you genuinely comfortable and confident right now that you're not going to have a problem affording the mortgage in the future, to be honest?
Yeah, I mean, one of the questions the lender would ask is, do you foresee any changes?
Yeah.
And you know, we don't want to get someone a mortgage that they can't afford. Definitely not. I wouldn't want to be involved in that, and I'm sure a client wouldn't want me to really as well. So I'm not sure what the investigation would be about, but I'm imagining it's something about it could stop you from trading or stop you from being able to earn money. So the last thing you want to be doing is getting a mortgage if that was the case.
Quite a risky time.
But I'm not a dentist, so I don't understand exactly what that means, but it sounds like it could be a risk that we need to look into.
Sure. It could be for a whole myriad of reasons. So it's one where obviously whoever's raised the question, absolutely speak with James and Michael or a residential mortgage advisor, and you can then speak very openly about your position.
Yeah, I mean, I think that buy-to-let mortgages are a lot less reliant on someone's income than the residential as well. So it depends on what the whole case scenario is. Really.
Perfect. Okay, I think we are, well, towards the, I finished with the questions that have been raised here now. So unless anybody's going to quickly type another one, I would like to thank everybody for listening. I would like to thank especially James and Michael for giving up your time this evening for such a wonderful presentation.
Thank you.
This has been recorded as well, so if there are bits that you've missed for whatever reason, we can provide you with a copy of the recording. I will wish you all a wonderful Thursday evening.
Thank you. Thank you very much.
Thank you, everybody. Thank you.
Bye-bye.
Bye.